Good morning, everyone. Happy Friday, and thank you very much for taking the time to join us today as we shine a spotlight on pay governance. And we'll focus in particular on the insights we have drawn from the recently completed second year of gender pay gap reporting in Ireland. My name is June O'Doherty, and I am a member of our ESG tax leadership team with responsibility for the S in ESG, if you like, the social aspect, which spans pay equity, pay fairness, pay transparency, and overall pay governance. Joining me today are Lindsay Smith, Eamon O'Connor, and Louise Shannon. Lindsay is Head of Reward at Vodafone. She has over 20 years of experience in HR and specialising in reward and pensions. And within Vodafone, Lindsay heads up the Ireland Reward function, working very closely with her global colleagues. Lindsay will speak with us today about Vodafone's experience of gender pay gap reporting and the organisation's approach to the broader pay fairness agenda as they prepare to meet their obligations under both CSRD and the EU Pay Transparency Directive. And then both Eamon and Louise are colleagues of mine in PwC. Eamon is a leading member of our gender pay gap reporting team, and he works very closely with Louise, who sits in our consulting practice, specialising in workforce strategy and workforce reward. Eamon, if I can start with you, more than 550 companies, so those with 250 or more employees in Ireland, published their gender pay gap reports last December, so December 23. As a team, we've spent the last number of weeks analysing the data and are delighted really to share our insights with everyone today. Eamon, can you share some of the headline statistics with us, please?
Yes, thanks, June. So we have conducted an analysis of more than 550 companies who published their pay gap reports for 2023. So firstly, just to recap on what the gender pay gap is. The gender pay gap is the difference in the average hourly pay of all males and all females in an organisation. So gender pay gap typically arises as a result of unequal gender representation at different levels of the organisation. A gender pay gap does not infer an absence of equal pay for equal work, which is a legal requirement. So I'm going to discuss the high-level statistics that we have uncovered from our analysis. So if we start with the hourly pay gap figures, the figures that are most likely to attract the attention of the media, the headline figure is that the mean hourly gap, which is the difference between the average hourly pay between males and females, that's fallen from 12.6% in 2022 down to 11.2% in 2023, which represents a reduction of 1.4%. The gap is slightly above the most recent gap reported by the CSO, who reported Ireland's gender pay gap at 9.6% in 2022, although the methodology used by the CSO is a bit different, and they would also be taking into account smaller companies. The median pay gap figure that we see has fallen also from 9.5% in 2022 down to 8% in 2023. So that's a reduction of 1.5%. The median gap, remember, represents the midpoint, so the male or the female who sits in the middle of the organisation with regard to hourly pay. So the first conclusion we can draw is we've seen some initial progress evidenced by a reduction in both headline pay gap figures for 2023. So if we move then to the bonus gaps, and what we can see in terms of mean and median bonus gaps is that the mean bonus gap saw almost no change in 2023, with a gap of 23%, just marginally above the 22.9% gap reported in 2022. The mean bonus gap is now just over twice the size of the mean pay gap overall. The median bonus gap actually increased this year. It's up to 11.9%, up from 8.6% in 2022. These bonus gaps are observed notwithstanding the fact that the percentage of males and females receiving a bonus was broadly even at about 66%. So this emphasises that there's overrepresentation of males in the senior positions, which typically correlates then to some higher bonus payments. You'll note from the scatter plot at the right-hand side of the screen that there's a huge disparity in the bonus gaps that organisations are actually reporting. So trying to draw conclusions from the average or median figures is difficult. You'll see that some pay gaps are above the 50% level and others have a gap in favour of women. And so there's just a huge disparity between what different organisations are reporting. Bonuses, of course, tend to be discretionary in their nature, so they're difficult to rely on as an aggregate gauge as they're prone to fluctuations on a year-on-year basis. It's important to note as well that the Irish approach for calculating bonus pay differs from, let's say, the UK methodology, which some of you may be familiar with. Under the Irish approach, bonus pay forms part of the overall pay gap as well. So that tells us that the overall pay gap has reduced in spite of not seeing any progress in the bonus gap. I think from working with our clients and analysing their results over the past year, we've identified that other factors can be attributed to a reduction in the overall pay gaps. So these include the impact of new joiners being included in the 2023 figures, or the impact of leavers or people retiring from the business, many of whom may have occupied the more highly paid roles and are now no longer included in the numbers. Also, changes to the basic pay structures of the existing employees, which might include internal promotions, can also impact on the pay gap. I think next then we'll look at some insights to understand what percentage of organisations have pay gaps that are in favour of males. So there's a few graphs on screen here at the moment. If we begin with the top left, we firstly look to analyse what percentage of the companies that reported in the survey disclosed a pay gap in favour of males. So the red signifies the 2023 figure and the orange the 2022 figure. So the number of companies disclosing a pay gap in favour of males is sitting at 86%, down slightly from 87% in 2022. So the vast majority of large organisations currently have a pay gap in favour of males. We next applied a 5% threshold to see how many companies have a pay gap above a 5% level, given that there's always likely to be one way or another some small element of a gap. The graphic at the top right of the screen shows us that 67% of companies disclosed a pay gap above 5% in 2023, down from 69% in 2022. There is relevance to identifying if the gap exceeds 5%, as the EU Pay Transparency Directive will soon impose additional requirements on organisations with pay gaps exceeding this threshold, although that will be on a category of worker basis, which Louise will cover in more detail in her section. Next then, we had a look at how many companies are above the national CSO average, which I referenced earlier at 9.6%. And comparing it to that average, we still see that 51% of companies are above this level, which is slightly down from 53% the previous year. But basically half of organisations are reporting above that 9.6% figure. So to summarise those comparisons, we're saying that 6 out of 7 companies approximately have a pay gap in favour of males. With a threshold of 5%, we still see that 2 out of 3 companies have a pay gap above 5% in favour of males. And if we increase this threshold to approximately 10%, about half the companies are still exceeding that 10% or so threshold. The final graph then on this screen just indicates the bonus pay gap. And so 80% of companies have a bonus pay gap, a mean gap in favour of males, down from 82% in 2022. So a small amount of progress here, but the vast majority of companies have their bonus gap currently skewed in favour of males. The next area I'd like to discuss is representation, because we know that representation or the lack thereof in senior roles is a major reason to why the pay gaps arise. So this graph is outlining representation of males and females across the 4 pay quartiles. The quartiles divide the workforce into 4 quarters based on average hourly pay. So the lower quartile will be the lowest 25% of earners based on average hourly pay. The upper quartile would have the top 25% of earners. When we do these comparisons, we need to identify the population of males and females in our actual population. So we identified that the females in the companies that we're analysing have 45.6% representation, while the males have 54.4%. So if we see this split in the graphs, that would indicate equal representation. So what we note then is if we start with the lower quartile, the females are overrepresented here because they're at 50.2%, which is significantly above the 45.6%, which would represent equal representation. So there's overrepresentation in the lowest pay quartile, which continues in the lower middle quartile, although not to as great an extent. And then there's a slight underrepresentation in the upper middle quartile, but really where we see the real gap is the upper quartile, the top 25% of earners. Here, the female representation is at 39.8%, and this level of underrepresentation is a key driver of the overall gap. When we dug a bit deeper into these figures, we found that the proportion of females tends to be lower in certain sectors. And so the engineering, construction, manufacturing, and technology sectors were some of the sectors where the proportion of females were lower. On the other side, the healthcare and retail sectors have a much higher ratio of females to males.
Eamon, a huge amount of detail there and a huge amount of analysis done. Thank you for sharing that. And if anyone has any questions or anything particular that they'd like us to look at in more detail or dig into, please don't hesitate to use the questions and answers function at the bottom of your screen. Eamon, what I would like to ask you now is just to give us a little bit of an overview in terms of sectoral insights. So how does the sector that a company belongs to impact, either positively or negatively, where their gender pay gap has landed?
Yes, so we've analysed the gaps by categorising companies into their sector. So the next graph illustrates pay gap changes on a sector basis. Now, I'll appreciate there's a lot of data on this particular slide, but what we have is each sector has a line chart, which at each end of the line chart, we have the lowest and the highest gaps that we can see. So on the left-hand side, we have the lowest gap, generally a gap in favour of females, and then on the right-hand side, it goes all the way out to companies with the highest pay gap for that particular sector. So the first observation there is that there's a huge disparity in most industries, even within the sector itself, depending on the company that's reporting. We then have the orange shading area, which signals the range where the majority of companies fall within that sector. So that's more kind of the middle ground for that particular sector. And we've then inserted a dot, which you can hopefully see, within that shaded area, and that's pointing to the mean gender pay gap for that particular sector. So the further to the right on the graph that you can see that dot, that indicates that there's a higher mean gender pay gap for that particular sector. So the highest gender pay gap disparities are being observed across the legal profession at 35%, the aviation has 33.5%, insurance at 23%, and construction at 21%. The charity and government sectors have some of the lowest gaps alongside manufacturing. We also then, as part of the analysis, had a look to see, now that we have 2 years of data, can we analyse the year-on-year change in these pay gaps? So we had a look to see what sectors are the gaps increasing and what sectors is there a reduction in the pay gap. So the largest increases are seen in the legal profession. So that's a part of the reason why that now has the largest gap overall. So up 6% this year. The entertainment and recreation sector was up 3%, and the increase in the mean pay gap for utilities was up 2.5%. In terms of decreases, we found that while aviation has amongst the highest pay gap overall, this sector experienced the largest decrease of 4% in the pay gap this year. The pay gap for the manufacturing sector was down 3.2%, and transport and storage was down 1.8%.
So movements overall, Eamon, but I think it's fair to say probably fairly muted rather than monumental. Should we be concerned about a lack of progress?
So I think there will be some valid concerns over the lack of progress, but there are a number of factors at play that mean the progress is always likely to be slow over the short run. So I think organisations will firstly point to a lack of time between the publishing of their 22 and their 23 reports. If we recall that the 22 pay gaps would have been published in December 2022, many very close to that year end, meaning organisations may not have been fully aware of the extent of their pay gap until December 2022. The 23 reports then are based on data for the 12 months up to June 2023. So you've got 6 months of 22 data and 6 months of 2023 data. And so companies have only just started reacting to what their first set of data is actually revealing, and they're reporting again. So while this might be understandable when the requirements are new and companies are getting to grips with them, I don't think this excuse is going to age well. So pressure will be on organizations to present evidence in their 2024 reporting that demonstrates they're making efforts to actually affect change. I think then it's also important to view the changes with a long-term perspective, because the actions which are required to implement effective change across industries and society as a whole, they're long-term in their nature, and they become expected to take 5 to 10 years before the results of actions can take their full effect. So this has been the experience in countries who have been first movers in mandatory gender pay reporting, such as the UK. I think it's also good to put into context that while the reduction of the 1.4% in the mean gender pay gap, so that this year it was down from 12.6% to 11.2%, if that rate of reduction was maintained year on year, you could see the pay gap eliminated over a period of 9 years. So important to retain a long-term perspective when trying to analyse these trends and look for progress. I think also then progress is not always going to be linear. Recruiting decisions taken by organizations, they can actually increase the gap in the short run before you get to long-term improvements, because some of the most effective strategies with a sustainable approach to closing the gender pay gap, they do take time. So you have the example where an organization looking to achieve longer-term sustainable gender diversity, they might hire more female employees at the more junior levels with a view to nurturing those individuals into more senior, highly paid roles over time. But actually hiring the relatively low paid females now could actually increase the mean gender pay gap in the short run. In the long run, however, if that talent could be retained and developed, the gap will become narrower and the organisation becomes better balanced over time. So just to conclude on that then, we're looking to maintain a long-term perspective when we're looking for change. The progress isn't always going to be linear, and that hopefully we will see some further improvements materialise if organisations adopt a sustainable approach to closing their pay gap.
Super, Eamon. Thank you for that. Lindsay, if I could turn to you, Vodafone is among the companies who published their own gender pay gap results recently, and you reported a 1% decrease in that mean hourly gap that Eamon defined for us. You have an ambition to be one of the world's leading employers for women by 2025. Could you explain to us the practical steps you're taking to address the gender pay gap and support your overall ambition? And I suspect that many of the actions you're taking will be of interest to our listeners this morning.
Sure, June. Hello, everybody. Well, at Vodafone, our gender pay gap is influenced by several factors, primarily by the structure of our business and the number of men and women at different levels in Vodafone. This leads to a result of more men than women holding senior or specialist levels and roles, and therefore higher paid roles, as well as an extended average tenure among these employees, which also plays a part. We were delighted to see the progress of our first gender pay gap findings in 2022 to our latest in 2023. We had an improvement in both the median, 12.6% down from 16.5% last year, and the mean hourly gender gap of 5.1% down from 6.1% last year, as you said. We are moving in the right direction, but while these figures are positive and stand below the country average, we realise that we still need to remain focused on delivering our strategic goals and initiatives which are designed to close the gap. For example, on the screen, you'll see now some of our global policies that we have within Vodafone, and we believe that we lead by example for our customers with award-winning policies and support that help our people, particularly women, succeed. Our market-leading women's health policies, such as our enhanced parental leave, maternity, surrogacy leave, fertility and pregnancy loss policies, as well as our menopause and domestic violence support programs, excel in this space, and our hybrid working policy supports blended working opportunities. Also, through our initiatives such as Code Like a Girl, a programme encouraging young women to consider technical careers, and our global STEM mentoring and work experience programme, which inspire female students. And we are committed to being an employer of choice for STEM graduates and ensuring a future female talent pipeline through this. Also, our internal growth skills platform, which was launched last year, gives our employees greater opportunities for self-directive learning, skills assessment and career development. So these initiatives and supports, to name a few, aim to retain women in our business, enabling further progression for them into more senior roles, and ensuring that they are supported through every life stage, and in turn will assist us in addressing our gender pay gap. We believe that being transparent is a critical factor to driving the positive change, and we believe that we can make that change. Our gender pay gap report helps us to understand better the challenges that exist in our pay in our organisation and where we can focus our efforts in the future. And as you mentioned, we have an ambition to be one of the world's leading employers for women in 2025. So we will remain committed to closing the gap as we continue to build a supportive environment where everyone can thrive, and one that is reflective of our customer base. And we're proud of our progress, but as I said, we still recognise there's more to do in this space.
Thanks, Lindsay. And I think you're right. I think it's never one and done. There's always more to do. And on that point, Louise, if I can turn to you, we've spent the last 20 odd minutes talking about gender pay gap this morning, but that's really only the tip of the iceberg when it comes to pay governance. And I think the most sweeping regulation that we'll see in the short term is the EU Pay Transparency Directive. Could you outline the key aspects of this for us, Louise?
Yes, sure, Dune. So the EU Pay Transparency Directive will be effective from June 2026, with the first year of reporting obligations in 2027. So we're waiting on the rules to be transposed into Irish law, and we need to bear in mind that countries may adopt the rules slightly differently. So at a high level, the directive itself is designed to make sure that workers of all genders receive equal pay for work of equal value. The directive covers two main areas: pay transparency and pay equity. So starting with pay equity, this is where you have your enhanced gender pay gap reporting, which will extend to categories of worker. So by category of worker, we mean similar jobs or work of equal value. And just to expand on what is meant by work of equal value, this is where you have two employees who do not do the same job, but their work is similar in terms of skill, effort, and responsibility. So under the directive, these employees will have to be paid equally even if their job titles are different. So where a pay gap of 5% or more is found in any category of worker and other criteria are not met, such as location or performance, a joint pay assessment must also be completed. This is quite an onerous process where an employer carries out a detailed analysis of the category of worker, sets out measures to address unjustified differences, and then provides this to workers, their representatives, and the equality and monitoring bodies, and subsequently looks to remedy the situation. A key point to note here is that the burden of proof on any pay discrimination is now with the employer, and employers are required to compensate workers if pay discrimination is proven. And this could include full back pay plus bonuses and any payment in kind. The sanctions for infringement of this directive are also likely to vary by country, and they're yet to be defined, but I would imagine that they will be proportionate enough to be effective. In terms of transparency, firstly, for job seekers, when it comes to recruitment, organisations will be required to provide information on salary levels or ranges as part of the recruitment process, and they can't ask about current pay during the application process. For employees, with regards to pay philosophy, employers must provide workers with information on what criteria are used to determine pay and pay progression. Employees also have the right to receive information on their individual and average pay levels, broken down by gender and worker category. So the directive will give workers much more access to information both before and during employment. Another key topic around pay regulations is the wider social reporting requirements within CSRD, of which pay equity is a key component. So within this, there are specific disclosures around compensation and adequate wages. For compensation, it's gender pay gap reporting and the total remuneration ratio. So your highest paid individual's remuneration divided by the median employee compensation. For adequate wages, this is your comparison of your lowest paid employee with applicable benchmarks like minimum wage or living wage. I know Lindsay is going to talk about Vodafone's use of living wage as a comparator there. And we are seeing more clients working towards using living wage as a method of ensuring a good standard of living for their workforce. So as well as these specific metrics, you're also required to share internal policies and measures that promote equal pay and diversity and inclusion goals. So we're seeing clients position pay equity within their broader ESG agenda, and indeed go beyond gender to consider other groups such as race, age, and disability.
Thanks, Louise. So very much around paying people accurately and paying people fairly. And obviously the CSRD, as you mentioned, the EU Pay Transparency Directive, as you referred to, are going to put additional heavy burdens on employers to do that and also to report on it. How can they best prepare now?
Yeah, so I think the first step is to ensure leadership is briefed and understands the directive, so it's given that appropriate level of attention. Then, based on the specific requirements, I think there are 4 key areas to focus on. So firstly, get a handle on your data, carry out an internal pay equity analysis based on your current pay practices, get a clear picture of any disparities, and then you can make an action plan to address them. Second is around your job architecture. Okay, so is your approach to levels and grades robust? Is it non-discriminatory and underpinned by some type of analytical job evaluation and classification methodology? You need to have gender-neutral tools and criteria to compare levels. So simply matching roles into a hierarchy based on salary levels and reporting lines or a pay benchmarking report is not enough. Third is establish your clear pay policies and procedures in recruitment, performance evaluation, career advancement and compensation, and make sure that they address pay discrimination. Lastly, then, raise awareness and understanding. Okay, this is really important by training up HR and management on the pay philosophy. So how do we reward staff? Factors that determine where they may sit on a range, and really ensure that they are fully equipped to have conversations on pay with their direct reports. So ultimately, the entire compensation process is about to get a lot more open, and organizations need to properly evaluate everything that goes into the way they make decisions around pay and pay progression. So in other words, who gets a promotion or a pay rise and who doesn't, and can you stand over those decisions? So I think it's important as well, just be upfront and honest with employees, have a strong communication strategy around this, including being open about any improvements that are being taken, and this will really help in the long run.
Thanks, Louise. So certainly a lot of concentration around the fundamental premise of paying a fair wage or a living wage as a starting point for those open and transparent conversations. We know from our own research in PwC, our recent PwC Global Living Wage Survey, that the issue of paying fairly and paying a living wage is rising up the agenda for organisations globally. That survey found that 67% of businesses believe that this is a priority for their organisation, and 53% expect to be making commitments in the next 5 years, which is brilliant. So while the direction of travel toward a living wage is clear, how to get there is less so, and Louise's suggestions as to how to start to prepare are really, really important. But there's no agreed global standard in place. The definitions of what constitutes a living wage can vary between countries, they can vary between industries. So working out how to pay that living wage globally is far from straightforward. And that's why it's so brilliant to have Lindsay with us today. Lindsay, I'm aware that Vodafone has fair pay principles in place which govern your approach to reward. Could you shed some light for us on how you determine really what fair play is and then how you go about applying it?
Of course, Jane. So yes, at Vodafone, our total reward framework is underpinned by our commitment to fair pay. So our fair pay principles govern our approach to reward across our businesses globally. We have 6 principles which we apply to every employee, regardless of level, location, or role. Our fair pay principles ensure that people are reported in a way that's market competitive, free from discrimination, and allows for a good standard of living. Our principles also make certain that our people have the opportunities to share in our success and have access to the benefits to support key life moments that everyone clearly and also that everyone clearly understands their overall reward package. So as mentioned, you can see on the screen our fair pay approach consists of 6 principles. So the first one being market competitive. So the pay of our people is really reflective of their skills, their role and the function, as well as the external market. So from a metric perspective, we take particular notice of the percentage of individuals that are below 80% compo ratio and the percentage of individuals above 120% compo ratio. So for those not strictly in a reward space, compo ratio is a measurement of pay that compares an employee's salary to the median compensation for similar positions within a company or a target market. And in Vodafone, we try to ensure that our staff fall within that 80 to 120% bracket of the benchmark. The second one then is free from discrimination. So our pay, we believe, should not be affected by gender, age, disability, gender identity or expression, sexual orientation, race, cultural heritage or belief. And again, with this principle, we review certain metrics such as the percentage of compo ratio, the gap between males and females, the average compo ratio by various groupings, the proportion of top performers and top potential various groupings, and then the average merit percentage increase. The third one then is provide a good standard of living. So we work with the independent organisation, the Fair Wage Network, to assess how our pay compares to the living wage in each of our markets globally. So the Fair Wage Network has developed a global database containing all known living wage amounts for each country. And then the calculation is based on a standard family unit size using 2 adults and the fertility rate in that location. We find in Vodafone, using this basis and the calculation and not the living wage verbalised by the government in each country, a better way to compare and contrast. 4 then is sharing in our successes. So all of our people we believe should have the opportunity to share in our success by being eligible to receive some form of performance-related pay, for example, a bonus, shares, or a sales incentive. 5 then is that we provide benefits for all. So our global standard is to offer a consistent standard or level of benefits for all of our employees. And then 6 is open and transparent. So under this principle, we ensure that our people understand their pay. We do this through a series of user-friendly guides, web pages, and an annual reward statement. With pay transparency, our view is that this space will evolve even further, as you heard earlier on from Louise. And we undertake annual review against our fair pay principles across all markets, utilising a digital dashboard to measure how we are performing. And then findings from this review then helps local HR and reward teams analyse the outcomes, discuss the position and progress against previously agreed areas of focus in their market, and then agree any actions that need to be taken where appropriate. Overall, within fair pay, our main areas of focus continue to be ensuring that we have no employee that falls below 80% compo ratio and reviewing and addressing that where possible in a timely manner. We also analyse compo ratio levels, annual salary review increases and promotions of our top performers and our top talent to help support retention. So overall, we believe that this work will help us and support us in our gender pay gap journey and to being more transparent with our employees on pay in the future.
Thanks, Lindsay. Some very practical principles there for everyone on the webcast this morning. And I can see even from some of the questions coming in, there is a desire for additional clarity or certainty around the obligations that are being placed on employers and the actions they can take. Eamon, one of the questions that is probably to be directed to you is from someone on the call who is a company looking to do its first year of reporting now this year. So that would be a company with 150 or less employees. Any practical steps or advice that you could give them, please?
Yes, so this year in 2024, companies that have more than 150 employees in one single entity will have mandatory reporting. So I think with smaller entities, we expect to see some larger gaps due to the smaller employee population size. We've already seen this with clients that we work with who might have calculated gender pay gaps for their smaller entities on a non-mandatory basis in preparation for mandatory reporting. Because with the smaller entities, the pay of the highest earning individuals will have a greater impact on the average pay gaps when compared with organisations that have larger employee numbers. So I think with that said, early preparation is really key. The companies must understand the legislative requirements and how they're going to apply to their employee population. The companies need to understand their pay structures. So that's going to include understanding all elements of ordinary pay, your bonus pay, the additional benefits that you might provide to employees and how they're captured, share-based pay if that's applicable to your organization, how overtime is captured, and how to report on the various leaves such as sick leave, maternity pay, etc. Integrating your payroll and HR data is also a challenge at times, so companies must understand what data sources are required to report effectively. If I'm thinking back now to the clients that we worked with in their first year of reporting a couple of years ago, I can recall that the commitment required in terms of resources, it was much more intensive than one might have expected at the outset. So our clients found they required significant resources to collect all the data required to interpret the legislation and to apply this then to their pay elements. Also, categorizing the pay elements takes time, and preparing the calculations then to arrive at each of the 11 mandatory reporting figures. So I think our advice here would be to engage as early as possible, because this gives you time then to actually resolve the issues that are going to inevitably arise in the first year of reporting. Also then, effective documentation of the steps you actually undertake in preparing the calculations is really essential to the success of future reporting. We really must remember that the reporting is going to be required on an annual basis. This is now an annual reporting requirement. And so consistency of approach is key, ensuring that you're actually comparing like with like information. Only by documenting the approach clearly can you be sure that you report on an equivalent basis every year. So taking the time to really set this in stone in year one can save a real headache in future years. Also, before companies get to the stage of actually publishing their pay gap, we'd really advise that you're double and triple checking the numbers, because you need to be sure the calculations are computationally accurate and in line with the methodology set out in the legislation. Some of the requirements are technically difficult to interpret, and it's easy to fall foul of the exact requirements the legislation stipulate. So when we were actually conducting this analysis of the 550 companies, we actually uncovered some common computational errors which control the validity of the numbers reported into question. So for example, we actually saw some reports where the quartiles that I talked about earlier, they didn't add up to 100% in all cases. So straight away, that's a red flag that the data and the mandatory numbers you're reporting might not be accurate. There are other more complex errors that we would have seen, which might include calculating the bonus gap by reference to all employees instead of just those who received a bonus. So we would have the bonus gap should only include employees who received some form of bonus pay in the reporting period, and not all employees. And if you include all employees, you'll ultimately report an inaccurate gap. So I think that's key. So basically, appropriate review of the numbers would be something that will really help to minimize this risk of errors. And if you're preparing the calculations in-house, it's really worth thinking about engaging some external help just to get a review of those final numbers before you publish them. Lastly, then, just worth noting that the 2025 reporting cycle is not that far away, and that's going to see the threshold fall to just 50 employees. So that's going to mean further resources, more time needed to report on smaller entities. So companies that are already in scope, but maybe they have some smaller entities that are not coming into mandatory reporting until 25, they might think about non-mandatory reporting, even internal reporting of those smaller entities this year, to be best positioned then for mandatory reporting come 2025.
Great, Eamon, thank you. And we did see, even before the legislation came in, that companies who voluntarily published their pay gaps in advance of that legislative date actually were best placed to take steps. So very good advice for companies with 50 or more employees. Eamon, when I have you, another question in just on numbers, is the 45-55 demographic split that you mentioned earlier in the presentation, is that representative of the Irish workforce as a whole?
So the split I had, yes, of the female population of the companies we surveyed, it was 45.6 to 54.4. It wouldn't be entirely representative of the workforce participation as a whole. I think the CSO data has the female participation in terms of the overall at about 48 to 49%, depending on which report you look at. But so I suppose it's key to bear in mind there that we are only looking at the larger organisations in the country, and so it's not going to be exactly representative. It's not going to include a lot of the SME business, which makes up most of the jobs in the economy. So while it's a large sample, it's not indicative of the entire Irish workforce.
Super, understood. Thank you. One question in for Louise and one in for Lindsay, if I take them in that order. Louise, the 5% pay gap that you mentioned, which is, if it's unjustified based on objective criteria, further work needs to be done. The question is, how does that gap take account of performance-related bonus awards? Yeah.
So the thing with the directive is there's enhancements in relation to reporting on both the category of worker, but then also the definition of pay is broadened as well. So it's not just your salary, it's likely to incorporate your bonus and benefits, for example, pension as well. So yeah, it's certainly more onerous.
Perfect. Okay. And Lindsay, a forward-looking one for you. You've obviously inspired lots of our listeners this morning. What's next for Vodafone on your inclusion journey?
Well, what's next? I suppose it's an interesting and an exciting time, June, and not to mention probably going to be a busy time for everybody. But next for Vodafone Ireland in this space is, I suppose, a new focus on our journey within pay transparency. So we propose to take on pay transparency through global consistency, powered by our global tools and through our HRS system, as well as working on the creation of global standards for within Vodafone. And where required, local adaptations of these standards will take place at a local level, for example, in relation to legal variations, etc. We're approaching this in a two-phased approach. So first in an internal focus and then externally. This is not only ensure compliance but with the directive, but there's a clear and meaningful understanding of the information available to all employees, both present and future.
Perfect, understood. Eamon, two for you. I might fire them both at you. Where are we in terms of penalties for non-compliance with gender pay gap reporting? And is there any sign of the central portal where reports could be uploaded and accessed centrally?
Yeah, so in terms of the penalties, there's currently no monetary penalties in place for non-compliance with the reporting requirements. An employer could be brought to the Workplace Relations Commission by an employee, but we haven't actually seen any cases of that taken just yet. I think at the moment, it's really a reputational issue. That reputation is the stake where organisations are failing to report. And we have actually seen that called out in the media around the time of reporting, where there's a certain small number of large organisations did not publish reports in time. And this was being called out in the media. So there's kind of a publicity issue and a reputational issue there for organisations. But I suppose that could become more significant in time. Certainly under the EU Pay Transparency Directive that Louise has discussed, the non-compliance will bring a more significant level of penalties going forward. We haven't had any major update on the central portal, so that was flagged to be introduced really as soon as the first year of reporting, but it was put on the back burner and hasn't really progressed. So eventually the idea is that there will be a government central portal that companies would upload their database, their report, so that there'd be a central database to access. But at the moment, we don't necessarily expect that would even be in place for 2024 reporting, but it might be a bit further down the line. We have seen with countries that have integrated that before that it does make the information much more accessible, and you can do a lot better analysis, more detailed analysis on the figures. But for now, it's a wait and see on that, and we might not have it for 2024 reporting.
Great. Okay, and it would make our job a lot easier as well, as you say. And the final one, because I'm conscious we're over the 45-minute mark. Can you share some advice, is the question, regarding reporting requirements for entities within a group who may be outside Ireland? So at the moment, the gender pay gap regulations are based and driven very much by your employee, so who their contract is with. If their contract is with an entity outside Ireland, if they work fully outside Ireland, then it's highly unlikely that they would be included within the scope of the reporting requirements. There are a number of other questions coming in, and we will do our best to get back to you directly on your specific question very shortly after the end of this webcast. But to wrap things up, can I just say a massive thank you to our speakers today, who have contributed to a very wide-ranging discussion where I hope you feel you've got a mix of both strategic guidance, forward-looking, as well as very practical tips. Thank you also to you for joining, and thank you for your questions and comments contributing to the conversation. As I said, I hope you found it useful. I hope you found it thought-provoking. And to coincide with this morning's webcast, we've published a report which provides a full analysis of all the data reported so far by Irish employers, just in case you didn't get any of Eamon's figures as he was going through it. And we've also included some tips as to the strategic actions you can take now to reduce or manage your organisation's gender pay gap. So please do check out the full report and the rest of our thought leadership at pwc.ie. Thanks again for your time today, and we're all very much looking forward to talking to you again soon. Thank you and goodbye.